Hello everyone, this is Louis. Welcome back. If this is your first time here, well, thank you for dropping by. Today I'll be talking about the new Advanced Life Deferred Annuities. On January 1st this year, the new tax rule permits Advanced Life Deferred Annuity to be a qualified annuity purchase, same as any other registered retirement plans. The payment start date can be deferred until you become 85 years old. According to a survey done by C.D. Howe Institute, it stated that more than half of the 65 years old Canadian will live past age 85. With more and more company pension plans disappearing, there are fewer sources of secure retirement income for the retirees. The retiring Canadians want their income to be protected for their later years. The Budget 2019 proposed a national advanced life deferred annuity plan that could ensure the seniors don't run out of money, but at the same time, it placed no new pressure on the Canadian public purse. The value of the purchased advanced life deferred annuity will not be included to calculate the minimum withdrawal from a RIF or other registered retirement plans after the year the ALDA was purchased. An individual is subject to a lifetime advanced life deferred annuity limit equal to 25% of the value of all property held in the qualifying retirement plans as at the end of previous year, and the amounts from the qualifying plan used to purchase ALDAs in previous year. Now, this limit will only apply when an ALDA is purchased or when an additional amount is added to an existing ALDA contract. The individual will not be required to dispose or surrender any of the ALDA purchases in previous year if it exceeds the individual's lifetime ALDA limit because of a decline in qualifying plan assets. An individual will also be subject to a lifetime advanced life deferred annuity dollar limit of $150,000 from all qualifying plans. This amount will be indexed to inflation for a taxation year after 2020, rounded to the nearest 10,000. The annuity contract needs to satisfy certain requirements before it can qualify as an advanced life deferred annuity. These include the income must commence no later than the end of the year in which the annuitant attains 85 years of age, and must provide an annual or more frequent periodic payment for the life of the annuitant or the joint lives of the annuitant's spouse or partner. With the joint life contract, when the annuitant dies before the commencement of the annuity payment, then the payment to the spouse or partner must commence no later than the time at which the payments would have commenced if the annuitant had not died. The advanced life deferred annuity periodic payments must be equal except when adjusted annually to reflect changes to the consumer price index or a fixed rate specified in the annuity contract not to exceed 2% per year, or the reduction is because of the death of the annuitant or the annuitant's spouse or partner. Now let's take a look at what happened to your advanced life deferred annuity following the death of the annuitant. If a lump sum death benefit is provided to a beneficiary, it must not exceed the premium paid for the annuity less the sum of all payments received by the annuitant, or in the case of a joint life contract, the sum of all payments received by the annuitant and the annuitant's spouse or partner before death. The tax treatment on death is quite similar to other registered retirement plans. With a joint life contract, all annuity payments to the surviving spouse or common law partner will be included in the income of the surviving spouse or common law partner. When the lump sum benefit is received by the surviving spouse or common law partner, or a financially dependent child or grandchild will be included in the income of the beneficiary. However, all or a portion of that amount will be permitted to be transferred on a tax-deferred basis to the beneficiary's own RRSP, RIF, or any other qualifying retirement vehicles, provided that if the beneficiary is a financially dependent child or grandchild, then they must be by reason of physical or mental infirmity. If the beneficiary of a lump sum benefit is not to the deceased spouse, nor a common law partner, nor a financially dependent child or grandchild, then the lump sum benefit to the beneficiary will be included in the income of the deceased annuitant for tax purposes in the year of death. Now, this is the part you need to be careful. If the purchase of the advanced life deferred annuity contract is more than the advanced life deferred annuity allowable limit, then it became a non-compliance issue, and the tax of 1% per month will apply to the excess portion. However, if the annuitant can establish that the excess portion was paid because of a reasonable error, and the excess portion is right away returned to an RSP or RIF or other eligible vehicles of the annuitant by the end of the year following the year in which the excess portion was paid, then the penalty will then be waived. So, is advanced life deferred annuity good for everyone? Well, not really. It may not be right for you if your CPP, OAS, and other pension benefits already fully cover your regular expenses, or if you are already over 80 years old, or you have less than $250,000 or more than $5 million in retirement savings, or you have an impaired health, or you're seeking more of an investment product instead of a guaranteed income, or you may suddenly feel that you need access to the retirement money. That's all for today. I hope you find the information useful. If you enjoyed the presentation, please give us a thumbs up and subscribe. Until the next time, take good care of yourself and be safe. I look forward to seeing you again soon. Goodbye.